Who do we have next here? We've got Garrick Monahan at Riaz Capital. So let me bring you on, and I'll tell you a little bit about Riaz and what they're doing as Garrick loads up here. They have a workforce housing opportunity zone fund that's located in Oakland, California. They do workforce housing all over the San Francisco Bay Area. Garrick, I got you on now. How are you doing there?
I'm doing well. Am I coming through? Can you hear me okay?
You are. I can hear you and I can see you. So we're 2 for 2 there.
All right.
You have a slide deck you want to share, yeah?
I do, yes. I want to just start off say thank you, Jimmy, and thank you everybody for joining, both presenters and attendees. It's been really interesting so far. So thank you all so much.
Well, thank you, Garrick, and we're glad to have you here. So, Garrick, and I'll turn it over to you now. Thank you.
All right, of course. So let me walk you through this. So first of all, I'm with Riaz Capital. We're a workforce housing developer in the San Francisco Bay Area. And I want to talk to you about our micro living strategy, which we developed in advance and prior to the Opportunity Zone legislation, similar to some of the other folks who may have already had a business plan in the works, and then we're able to layer on Opportunity Zone tax benefits to make it even more attractive to investors. We similarly were already developing and building for this strategy in the Bay Area. And then the Opportunity Zone was created around the neighborhood where we were already operating. So let me walk you through a little background on Riaz Capital. We've been a developer in the Bay Area for 20 plus years. Started off as a family firm and originally did, our firm principal, Riaz Capital, did a lot of design build work, particularly in the luxury end of the market. In the last decade or so, we've pivoted more to being an entry-level workforce housing developer focused on the East Bay Area and really with our epicenter in Oakland. Over the last decade, we've had a blended IRR on exited projects of 36%. And I've highlighted some details of our most recent 3 projects here. First, Hannah Park, we did a 90-unit ground-up steel frame construction in West Oakland with total capitalized costs of $35 million and building at a cost per residence around $380,000. We really focus on this metric of how much it costs us to build a single residential unit, whereas other folks are focused on cost per square foot and things like that. When we're trying to build at an affordable price point, the cost per residence is really the metric that we've learned to focus on. On average in our submarket, it costs about $570,000, $580,000 per residence. So even though this project in Hannah was a little bit above our target price point for the entry-level customer, we still actually are able to build at a lower cost per residence than most of our competitors or most other developers in the region. More interesting are these 2 other more recent projects, which have really informed the go-forward strategy and what we're offering with this Opportunity Zone Fund. First, we did a church conversion project in East Oakland. We converted this old church that was sitting empty and unused into 60 units of workforce housing. We were able to do that at a very low cost per residence and ultimately achieved an average rent per unit that was within HUD affordability guidelines for the region at around $2,000 per unit on average. And in particular, we were able to rent quite a few studios that are really within the affordability targets that we set for ourselves. And then finally, our most recent project, the Linden here, was a sort of a smaller but really critical test case of our most recent designs, where we built to a cost per residence of roughly $230,000, but have been able to achieve lower rents while still maintaining high stabilized returns on cost. So over 6% return on cost for this development and still hitting an average rent per unit that's well within affordability guidelines. So hitting some of the social impact story that we have and what we're trying to accomplish for the housing crisis here in the Bay Area, while still providing generous returns to our investors. So what are we doing? We're focused on an urban workforce housing solution, which we call our micro studio strategy. We target a high yield with a net investor IRR of 16%. This is before you factor in the additional benefits of the opportunity zone for those who enjoy those benefits. We have a predictable cash flow with an average 12% cash on cash over the 10-year hold. And we're able to return roughly 60% of investor capital by year 5. So we have a pretty high velocity with that return of capital because our development cycle is much shorter than a lot of other folks, a lot of other developers in the region. We're also very focused on providing a low risk to our investors. We underwrite every project so that rents can drop by 30% or more before we're at risk of missing debt payments and or losing any assets. This is fundamentally what we're building. It's a micro studio where we provide the privacy and benefits of a studio apartment at a price point much lower than what is currently available in the submarket. And to throw some numbers on that, we recently leased up our most recent project and found that we had very high customer demand and that we were achieving a lot of stability in the customer base that we saw. So whereas in the San Francisco Bay Area, one tends to see really high concentrations of employment and professional sector in the residence. So for example, at the luxury end of the market, you might see 70, 80% concentration in tech or finance, depending on the location of a building. In our most recent project, we didn't have a single professional sector concentration above 20%, or 21% to be precise. And what that means is throughout the past 8 months, while the luxury end of multifamily has seen a lot of volatility throughout COVID as a lot of people have moved to work from home, have gone on long sabbaticals or worked remotely from destination type towns. Our customer base has generally been still employed locally, and we haven't seen anything like the drop in collections or occupancy that's really affected the luxury end of the market. So specifically, in our operating portfolio of about 1,200 units at this price point in Oakland today, we've had average vacancy around 2-3%. Last month, we ended at 2.8% vacancy in that portfolio. And in the last 6 months, have averaged 98% collections throughout the pandemic. So that stability of our customer and the fact that folks like teachers, firefighters, nurses who we're generally renting to can't necessarily work remotely when they need to be in a medical office, need to be in a classroom. We've seen a lot of stability at this price point, and that's something that we understood about this customer in advance, but COVID-19 has obviously proven to us with a lot more data. The other thing that was surprising with our most recent project, when one thinks about micro studios, particularly in the urban context, one thinks about a younger customer typically, but we found our average age on our most recent project was 33, and our average income around 75 grand. Now, I know we have attendees at this pitch day from all across the country, but in most parts of America, $75,000 a year is a very good salary. In the Bay Area, that's a little bit below median income. It's about 81% of area median income, but it is a comfortable salary. So we're not necessarily hitting the lowest price point and the lowest rung of affordability at this project, but we've maintained a rent ratio of 30% across the board. So we are still hitting HUD affordability targets, and frankly, we're serving what is the most underserved demographic in the Bay Area. For those folks who are less familiar with the housing crisis that we have going on in the region, the most underserved portion of our housing market is in fact this median middle income, or what some folks call the missing middle of our housing market. It's estimated over the past 20 years, the Bay Area needed to add roughly 430,000 units of housing for folks who earn between $40,000 and $120,000 a year. In that time, we added 22,000 units. So there's a 408,000 unit shortfall at this price point across the Bay Area. If we can build just a fraction of those units, we'll both be solving a major societal problem in our region, and frankly, building for a very stable customer where we know there's consistent demand. We also, in our go-forward projects, have found ways to utilize additional legislation that California has put forward to encourage the building of this median income or moderate price point housing, where we can achieve greater densities in urban areas, particularly around core commercial districts, while still maintaining the same value proposition that we've had in our lower density projects. Specifically for folks who are familiar with Oakland or the East Bay, we have sites that we've closed on or in contract in old downtown Oakland and Jack London Square, both of which have seen real revitalizations in the last decade or two, and which we're really proud to be contributing to turning what are currently vacant or abandoned sites into what are going to be really thriving residential buildings. So we're really focused on the cost per resident to build, as well as because it allows us to achieve a rent per resident that meets these affordability metrics. So on the left-hand side, we have our standard studio design. This is what the majority of our units in the fund will look like, where we're really achieving everything in a traditional studio apartment, but able to do so at a slightly smaller square footage, and therefore hitting a rent per resident in an efficient building that's well below the regional averages and roughly 20% discount to what you can get a studio for in the rest of the submarket. On the right-hand side, we have our more innovative product we call the micro studio. These are roughly the same square footage, but we achieve real significant economies by putting the main kitchen in a shared space. So although we really have moved away from or don't necessarily think of ourselves as a co-living operator, we've borrowed some ideas in that by sharing a small amount of square footage, we can actually achieve much better savings and pass that on as affordability to our customer. So there's a common washer, dryer, and full cooking area in here, as well as a kitchenette in the private studio space. So whether it's for COVID concerns or just general privacy, we still are very focused on providing the full functionality of a private studio with our micro studio product. But by putting this, these common offerings of the washer dryer and the larger oven in this shared kitchen area, we get a lot of savings that we can pass on to our residents. Let me go to this next slide here. So just to compare where we stand to the submarket and what other developers have been able to achieve, our square footage is roughly 300 square feet per studio. And on our go forward projects, we'll be averaging a rent around $1,900 to $2,000, which means residents can qualify for our units with an income of $75,000 or more. Again, about 80% of area median income. For someone to upgrade or who's otherwise looking for a studio in this area, they would need to earn roughly 36%, 47%, or on average 40% more to qualify for that studio apartment. So we're really focused on this qualifying income because the difference in qualifying income between somebody who earns $75,000 and $91,000 or even $100,000 is a difference in income that a lot of these customers aren't necessarily going to be making. If you're a teacher in Oakland, that's a raise that you may never get. So we're really focused on being able to build to the lower qualifying income here. I mentioned earlier that we're also very focused on low risk. So we have a 65% loan to cost on our going construction, and we refinance back to a 60% loan to value on our stabilized buildings. Put a little differently, we're very focused on what can our rents drop to before we have an issue covering our loans. So on the construction loan, we could afford a 40% drop in the base rents that we've underwritten, and on our permanent loan, a 30% drop in base rents. Historically, the Bay Area has never experienced more than an 18% blended rent drop. And in the workforce housing sector, like I said, there's lower volatility. We saw at our worst in the last 50 years, a drop of 4% the workforce housing into the market. So we're very sensitive to that number, and we think we've built in quite a bit of downside protection. Really quick, just to summarize how we get to these economies, and then I'd love to open it up for some questions. We focus on achieving hidden density within the urban area. So rather than going for mega projects that really stand out, attract a lot of political blowback and NIMBYism, which is really the greatest risk to housing development in the Bay Area, we focus on what we call hidden density. So building smaller sites, but a portfolio strategy, so we can still deploy roughly the same amount of capital, but fly through the entitlement process much more smoothly. We also, as I mentioned, take advantage of some legislated incentives for building housing, in particular, California's density bonus legislation, which allows us to achieve greater density on smaller sites. And then second, we're really focused on building efficient buildings. There's a big trend in multifamily over the past decade or so to layer in amenity spaces, whether that's the dog washing station, the coffee lounge, the game room, whatever it might be. We're renting to a customer who can't necessarily afford the additional costs that those things create when you add them to a building. And frankly, we're located in excellent urban areas where those amenities are available within the neighborhood surrounding our building. Rather than trying to provide the best possible coffee lounge, our resident can go down the street and go to the Blue Bottle and get a much better experience than we're ever going to be able to provide. That's not our core business. We should let the city provide those things to these residents. And it allows us to pass on significant savings to our resident and access a much larger leasing market. Really quickly to run through the returns and cash flows. Like I said, we spend the first couple of years building, and then by the end of year 4, we'll have refinanced our portfolio of projects to return roughly 60% of investor capital. And from that point forward, are simply making operating distributions. We've also built in a large distribution in 2026 to help our investors cover the eventual tax bill that will come for those who are deferring capital gains taxes from this year. Ultimately, we're targeting a 16% investor IRR. Let me just stick with this for a second, and a 2.6x equity multiple. This is a quick summary of our firm. We can jump past that. And then I do want to just point out, we've done some sensitivity analysis. We originally underwrote the fund pre-COVID, obviously, and the world has changed a little bit since then. So we went back and took a look at some of our assumptions to see how those sensitivities might affect the returns on the fund. Given what we found in our leasing, we actually think our current expectation around rents is pretty solid, and we're very confident with that. We've even seen some increase in the rents that we underwrote. More importantly, the interest rates are much better than we expected on permanent financing. We can get things in the low 3s at this point, which if we were able to achieve, along with the rent increase, there's significant upside potential from what we've already underwritten in terms of the IRR, cash on cash, or the equity multiple. With that, I'll just open it up for questions and see what anybody else has.
All right.
Yeah.
Well, awesome. Thank you, Garrick. We got time for 2 or 3 questions here. First one comes from Alexei. He asks, does your fund pass depreciation costs on to investors?
Yes, we do distribute depreciation. All of the operating distributions throughout the period will be depreciation sheltered. So even for folks who weren't necessarily taking Opportunity Zone benefits, they would have fully tax deferred distributions throughout the whole period.
Good stuff. And then Carl asks, how are you generating the additional cash flow in 2026 to allow investors to meet their tax obligation, another refinance, an asset sale, et cetera?
Yeah, great question. We're expecting another refinance. So we under lever a little bit with the initial refinances, both for a downside protection purposes, so that we don't take on too much leverage and too much risk, but also so that we can finance this additional distribution in 2026. We also assume some appreciation to allow us to go in and refinance again.
Very good. This next question comes from Kelvin here. as a result of COVID and work from anywhere, there has been a significant outmigration from the Bay Area. Aren't you already testing the 30% decline in rents? He asked this question about 10 minutes ago or so when you were going through the earlier part of your deck.
Yeah, good question. I would just draw your attention back to this slide, which is really fundamentally, yes, there is a significant decline in rents or collections in multifamily as a whole in the Bay Area, just like you've seen in other core urban markets like New York. But what we have also seen is if you segment the multifamily collections and occupancies, what you see is at the lower price points, you've had much more stability. So like I said, our average collections over the last 6 months have been 98%. We have still very low vacancies. Our blended economic occupancy, basically taking the vacancy and the collections together, is 95%, which is very standard for multifamily. So we feel very comfortable that there will still be demand in the Bay Area for this price point. These are residents who aren't necessarily able to go, work from Aspen. They need to show up at work, and these are people who are nurses, they're city employees, they might be delivery drivers. These are folks who have maybe stable work, but not necessarily high salaries, where they have the financial ability to pick up and leave.
Good. Question just came in the chat. Sorry if I missed this, but what's the minimum investment for your fund, Patrick? Or I'm sorry, Garrick?
No problem. So we've set a minimum investment of $100,000 for new clients. And if anybody wants to learn more or doesn't feel particularly comfortable with that size, I would encourage people to reach out directly. But that's typically our minimum.
All right. Got 2 more questions, then I'm going to cut you loose. I know I'm keeping you over here, but I appreciate
that's okay.
Hey, appreciate you hanging out. We got a lot of good questions on this panel here. So any plans to make your buildings zero net energy or zero carbon?
The simple answer is no, we don't. The more complicated answer is we actually have a different perspective on what makes a building energy efficient and what makes it climate friendly. There's a lot of emphasis in development around, whether you're LEED certified or this or that, but LEED doesn't necessarily take into account the most important element of a building from a climate standpoint or an emission standpoint, which is where is that building located? So we're very focused on providing buildings directly in the urban center where someone has access to transit or can bike or walk to their both amenities and necessities. Whereas if you're building in a suburban development, even if it's a net zero building and your resident then gets in their car to commute 60 miles to work, you have a net carbon footprint that's much higher in those suburban buildings. We are still, working to maintain efficiencies, and we do, no gas, for example, in our buildings. We have solar on some, not necessarily all of our projects, depending feasibility, but it's something we're conscious of.
Excellent. All right. Well, we do have a couple other questions. They'll have to go left unanswered for now. I'll forward them on to you, though, Garrick. Maybe you can answer them in the chat.
Thank you. Yeah, I'd love to. And if people have additional questions, I'd encourage them to reach out to me via email or to go to our website at riazcapital.com.
riazcapital.com. Okay. Well, Garrick, awesome presentation. Thank you. I'm going to stop your sharing, and I'm going to kick you off stage here so I can bring in the next participant. But thank you again, and I'll forward those questions on to you if you want to hang out in the chat here for a few more minutes.
Thank you.
So